the CEO who stole $11 billion, WorldCom. In 2002, $11 billion disappeared from the books of one of America's largest companies. Not because the business failed. Not because the market crashed. Because one man decided to cook the books on a scale nobody had ever seen before. The company was WorldCom. The man was Bernie Ebbers, a former gym teacher from small-town Mississippi who built a telecom empire worth $180 billion and then destroyed it with a pencil and a lie. This is the story of the largest accounting fraud in American history, and how one CEO convinced an entire company to help him steal $11 billion in plain sight. Bernie Ebbers did not come from Wall Street. He did not have an MBA. He grew up in Edmonton, Canada, and moved to Mississippi where he became a high school basketball coach and gym teacher. He also ran a motel. But in 1983, Ebbers saw an opportunity. The breakup of AT&T had created a new market for long-distance phone service. Small companies could now resell long-distance minutes at a discount. Ebbers and a group of investors started a tiny company called LDDS, Long Distance Discount Services. Ebbers had no technical knowledge of telecommunications. But he had something else, an almost supernatural ability to acquire other companies. Over the next 15 years, Ebbers bought company after company after company. More than 60 acquisitions in total. Each acquisition made LDDS bigger. Each deal pushed the stock price higher. And each time the stock went up, Ebbers used that inflated stock to buy the next company. It was a perpetual growth machine fueled by acquisitions. In 1995, LDDS changed its name to WorldCom. And by 1998, WorldCom had pulled off the largest merger in American history at the time, acquiring MCI Communications for $37 billion. WorldCom was now the second largest long-distance carrier in the United States, behind only AT&T. Bernie Ebbers, the former gym teacher, was now one of the most powerful CEOs in America. His net worth exceeded $1 billion. He owned a ranch in Mississippi, a yacht, timberland in multiple states, and even a minor league hockey team. But there was a problem. WorldCom's growth strategy depended entirely on acquisitions. Buy a company, cut costs, show Wall Street the revenue growth, and use the rising stock to buy the next one. Without acquisitions, there was no growth story. In 1999, WorldCom tried to acquire Sprint for $129 billion. It would have been the largest corporate merger in history. But the Department of Justice blocked the deal on antitrust grounds. And just like that, the engine stopped. Without new acquisitions, WorldCom had to show organic growth. And the truth was devastating. The telecom industry was entering a brutal downturn. Demand for long-distance service was falling. Revenue was declining. And WorldCom's expenses were ballooning. Wall Street expected growth. Bernie Ebbers had promised growth. But the numbers simply were not there. And here is where it gets personal. Ebbers had borrowed over $400 million from WorldCom, using his company's stock as collateral. If the stock price dropped, the banks would issue margin calls. He would have to sell stock to cover his debts, which would tank the price further, triggering more margin calls. It was a death spiral waiting to happen. Bernie Ebbers needed the stock price to stay up. Not just for the company. For himself. And so he turned to his CFO, Scott Sullivan, and together they made a decision that would result in the largest corporate fraud in American history. The fraud at WorldCom was breathtaking in its simplicity. It basically came down to two tricks. Trick number one, they reclassified expenses as capital investments. When WorldCom paid to use other companies' phone networks, that was an operating expense. It should have been recorded immediately as a cost of doing business. Instead, Sullivan's accounting team moved billions of dollars in line costs off the expense sheet and onto the capital expenditure ledger. Why does this matter? Because operating expenses reduce your profit immediately. But capital expenditures get spread out over years. By moving expenses to the capital side, WorldCom was hiding billions in costs and making it look like the company was far more profitable than it actually was. Trick number two, they fabricated revenue. When the expense trick was not enough, Sullivan's team simply created fake entries. They booked revenue that did not exist. Hundreds of millions of dollars in phantom income, typed into spreadsheets by accountants who were told not to ask questions. Over the course of 5 quarters, from late 2000 to early 2002, WorldCom inflated its assets by approximately $11 billion. $11 billion in fake numbers, hidden in the books of one of the most scrutinized companies in America. And the people doing it knew it was wrong. Accountants later testified that they were told to make the entries and to keep quiet. Some were told it was temporary, that the numbers would be corrected later. They never were. The auditor, Arthur Andersen, the same firm that had been auditing Enron, failed to catch any of it. They signed off on the books, year after year, while $11 billion in fraud sat right in front of them.